Let's talk about Roberto. Roberto is a foreign citizen who's been living and working in Milan for 5 years. And before moving to Italy, he owned a small piece of land in Spain. And last year, he decided to sell that land for, let's say, 100,000 to free up some capital. He transferred the full amount from his foreign account to his Italian bank account. Roberto was excited. It was his own money from an asset he owned for years before becoming an Italian tax resident. He had already paid any applicable capital gains tax in the foreign country on the sale, so he believed he was in the clear. However, just like Maria, Roberto received a letter from the Italian tax authorities, and they had flagged this 100,000 inbound transfer. Since there was no explanation or documents tied to the transfer on his bank records, the authorities treated this 100,000 again as new taxable income. And for Roberto, depending on his other income, now the penalties are between 30 to 40,000. Fully taxed ordinary income. The fundamental issue here is, as you can see, the lack of proof. Even if the money was yours and not new income, the Italian tax system operates on a principle of self-declaration and then potential verification. And if the audit, the verification process shows unexplained sum, they will argue on the side of it being taxable. What should Roberto have done? Well, probably some documents beforehand, like the original purchase agreement of the land, the agreement for the sale, showing the sale price, proof of the payment of any capital gains taxes paid in the foreign country, the bank statement showing the transfer from the foreign bank account to the Italian bank account, clearly linking, the funds of the property sale. By having all these numbers and data ready, Roberto could have easily demonstrated for the 100,000 was not income to Italy. But rather than fighting the Italian revenue agency with just your word, it's way better for you to have some data and official documents proving that.